The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The biggest issue for those sky-high tech earnings may be those sky-high investor expectations. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Sky-high expectations maybe, coming down a little bit today. The S&P 500 off its lows of the sessions, but still down by about 0.5% here. And again, it's this cascade which explains what's going on. Big tech really taking a hit today. The Nasdaq 100 down by 1.8%. And a lot of that weakness is coming through once again in the chip names. We got some numbers from Samsung, not enough to really excite investors. You can see that being expressed when it comes to the Philadelphia Semiconductor Index, off by about 5.5% right now. And meanwhile, you also have a sell-off when it comes to the bond market. 10-year Treasury yields higher by about 6 basis points at the moment. We're back above 4.5%. And attention turning once again towards oil, Romaine.
Yeah, red across the screen there, but let's focus on the Nasdaq 100. Yesterday's 1.3% gain flipping to a 1.8% loss this Tuesday. That's the 7th consecutive session that index has moved 1% or more, the longest such stretch since an 8-day volatile run back in August of 2024. The Cboe Volatility Index for the Nasdaq 100 index now averaging a reading of about 28 since the beginning of June, and that compares to 17 for the VIX gauge for the broader S&P. That's the widest sustained gap that we've seen between the two since 2002. Now, the extreme swings come just as South Korean memory chip maker SK Hynix is taking orders for a U.S. share sale that was expected to fetch $29 billion in what would be the largest ever listing by a foreign company. Its shares in Seoul, though, plunged 8% today after its main rival Samsung reported that 19-fold surge in quarterly profits that apparently wasn't enough to impress investors who had bid up the shares 150% since the start of the year. The curse there of high expectations. And that, of course, means a big part of the broader market is still going to be dependent on the non-AI big tech cohorts to clear that, well, I guess, relatively lower bar for corporate earnings in order to keep the rally going. And that actually might be more of a question mark than some investors want to admit.
The big picture still remains that AI is a very revolutionary technology. Everyone agrees on that. But the key question now is how long time is it going to take before this shows up, especially in profit margins outside the Magnificent Seven?
Torsten Slok on Bloomberg Surveillance earlier. A lot of questions right now about what actually ends up driving the market next.
Well, it adds up to a really interesting setup when it comes to traders, when it comes to investors. And behind me, this chart, I have the S&P 500 one-month implied correlation, so between the members here. And you can see that implied correlation, how much the members are actually moving with each other, has dropped near record lows here. We're back towards levels that we last reached in 2024. And again, going back close to record lows. So it's interesting, Romaine, this setup for stock pickers specifically, the bottoms-up analysis here, rather than just the index moving as a whole. Dispersion is the name of the game.
All right, let's bring Mandy Zhu into the conversation, Vice President and Head of Derivatives Market Intelligence over at Cboe Global Markets. Talk a little bit about some of the moves that we've seen. I do want to talk about correlations, Mandy, but I also want to start first off with some of the volatility that we're seeing specifically on the tech stock side. So maybe we can take the Nasdaq 100 stocks, whatever you want to talk about. But I am curious as to what you're seeing with regards to your own research and data.
Yeah, sure. The volatility that we're seeing in the market right now is very specific to certain sectors, and it's very specific to the stock level. So if we look at the tech sector specifically, the volatility, we have an index called VXN, which tracks the VIX essentially for the Nasdaq 100. The spread of that index relative to the VIX, so the excess risk premium that traders are courting for the tech sector more broadly, it's the widest since the tech bubble. So that's how extreme it's gotten. Now, if you look at the average, like at the stock level, what we're seeing is just a lot of volatility at the single stock level. It's not just tech sector, but it's largely driven by the tech sector. If you look at our VIX EQ index, which is our VIX for average single stock volatility, that relative to the VIX is also at a record high. So what it's really telling you is right now, macro risk, market-wide risk as measured by the VIX is fairly muted, but there's a lot of risk at the idiosyncratic stock level, and there's also a lot of risk, obviously, with the tech trade.
How do traders protect against that? Do they hedge specifically against those individual stocks, or is it just they don't buy them at all?
It's interesting. Yeah. So you would think, given the uncertainty with kind of the outlook with the tech sector and some of the recent volatility, that we would see a spate of hedging activity. And at the index level, we really haven't seen that. So if you look at, for example, QQQ, measures of skew, which is measures kind of demand for protection in that index, it's fairly muted, actually. And the same story with SPX. So we're not really seeing a lot of hedging. Where we are seeing hedging at the index level, actually interesting, is at the small caps. For the small cap, and they've been the outperformers. So it's not really at the heart of the volatility. It's actually the outperformers of the year where we're seeing elevated hedging activity, people looking to lock in those gains.
Interesting, because certainly what a run small caps have been on. It makes sense that investors may be looking to protect some of those gains. I do want to talk a little bit about what we're seeing, the interplay between the leveraged ETF complex and the broader market, because especially when it comes to South Korea and some of those chip names, there has been a lot of concern over whether the tail is starting to wag the dog. And, you know, when you take a look at the derivatives market, I wonder what it tells you.
Sure. I would say the derivatives market level, so the leveraged ETFs, I think, is a little bit different story. Now, there is some concern that the leverage, the rebalancing going on in those ETFs could impact the underlying stocks. But I would say, actually, if you're looking at the kind of the increase in volatility in the derivatives market, it's actually less than what we see in terms of the realized volatility in those specific names or in that specific sector. So it hasn't been outsized in the derivatives market relative to what we're seeing actually in terms of realized moves in the market. So altogether, I would say there really hasn't been much, back to my earlier point, much panic or much demand for hedging, whether at the index level or at the single stock level, and whether that changes, going forward as we go into earnings season. Obviously that remains to be seen.
That's what I'm curious about. As we, go into some more of these rebalances when it comes to leverage ETFs, which are certainly a force when it comes to the U.S. market as well. And then you think about just the index rebalances that we're getting. You think about all the volume that we saw around the Russell rebalances. Are those becoming more exploitable events?
I don't know about more exploitable. They're certainly important, and I think especially with obviously SpaceX and the inclusion in certain indices, they've gotten a lot of questions and a lot of focus around kind of could that be a factor in driving some of the widening in volatility that we've seen between Nasdaq versus SPX. Obviously, it's going to be included in Nasdaq and not the S&P right now. And I would say it may be a factor going forward, but right now it hasn't really been a major factor. Like I mentioned, the implied volatility that's been widening to multi-decade highs, that's been less than what we've seen on the realized front. So I would say right now, really, what's driving the volatility in the tech sector, it's fundamentals, right?
Yeah.
It's positioning, it's crowding, it's a fundamental outlook getting more uncertain.
Well, let's talk about the fundamentals. I am curious as to what type of increase in volatility and activity that you see heading into an earnings season, which I guess ostensibly kicks off probably next week with towards the end of the week. Yep. Is there a sense here that we should expect to see even higher volatility now that we're going to actually have to hear from these companies?
Yeah, I would say this is probably going to be the most impactful earnings season, in recent memory, and at least judging by what is being priced into the options market. So if you look at VIX EQ, like I mentioned, that's the average VIX for single stock options. That's at the highest level since we saw Liberation Day. It's just a touch below the highs that we saw last April. Recall that was when VIX hit 60. So single stock options is saying this is there's just tremendous amount of risk regarding kind of the outlook and the direction of some of these stocks, but the VIX itself is not really reacting because of the dispersion and the low correlation, which Katie mentioned before. That is suppressing index volatility. The risk right now is more at the single stock level, is more with the fundamental direction and with earnings of these names.
All right, Mandy, always a great conversation, great insights as always. Mandy Zhu, VP, Head of Derivatives Market Intelligence over at Cboe, kicking us off to the close here on this Tuesday afternoon. When we come back, we take a look at shares at TeraWulf, giving back all of the gains from yesterday, despite that big tie-up with Anthropic. We're going to catch up with the CEO, Paul Prager, to discuss that new deal and the booming data center demand. That's coming up next here on The Close, right here on Bloomberg.
TeraWulf shares on the decline today after yesterday's big rally. The once Bitcoin miner turned data center lessor signing a 20-year lease agreement with Anthropic for its justified data campus in Kentucky. Joining us now is Paul Prager. He is TeraWulf chairman and CEO. Paul, Great to have you with us. I want to talk about the fact that this is a 20-year lease, because taking a look at the sell side reaction, you had analysts from Bernstein point out that most of your peers, they're still securing 10 to 15-year base contracts. So talk to us about how it all came together in the end.
We have a pretty competitive process. We know Anthropic well. They're up at our Lake Mariner facility. We decided to work with them on this. Duration's important. We have great quality sites, so we're looking for a long-term, high-quality credit as an off-taker. We had a reference design. They were familiar with us. We worked with them. It just seemed like the right thing. And 20 years is the best-in-class lease in this space right now.
So I also wanted to touch on some of the concerns, because again, reading through the reaction on Wall Street, obviously you saw a lot of that come through in the share movement yesterday, but there is still this concern around here that, okay, you secured this deal with Anthropic, but your customer concentration could be a longer term concern. So give us the roadmap about, how you begin to address this and how you keep that momentum going.
I don't share that concern. At our Lake Mariner facility, where our customer is FluidStack, backed by a Google credit backstop. It's pretty fantastic. Now here we've got a direct lease with Anthropic. I think it's one of the first things they've gone direct on, certainly for this term. They're a great credit. We'll have the lease provides for terms that enable us to get an investment grade backstop. Anthropic has a number of offers. They have to make a decision on whose equipment they want to use, but at the end of the day, this will be an investment grade backstop. Provisions in the lease mandate that, and all systems are go. We're very excited about building out this facility.
I'm curious, Paul, when you bought that center out there in Kentucky, did you already kind of know that Anthropic was going to come on board?
We knew that they were very keen on the site. We had a number of other customers that were interested in the site. We run a process. For us, it's all about getting the best deal we can for our shareholders. But at the end of the day, Anthropic put the most superior deal on the table. And we're excited to work with them again.
Do they hold any expansion rights to any of the other properties like that one you bought in May, somewhere in eastern Kentucky?
Well, no, but to be honest with you, when you've got somebody at a site and you scale that site up, we think ultimately this is a 500 megawatt site, 401 net. We think that ultimately the site is scalable to a gig. Having somebody there, having worked with them, having a reference design, them having been through all the diligence on the site certainly gives them an advantage, but it's not required. I mean, we're looking for the best deal we can for our stakeholders. We're always going to make that competitive. But I can tell you Anthropic is also a great partner. I mean, when you negotiate with them, they're looking for a win-win. It's not like this is what you get, this is what we get. It's just been a great working relationship. We built, probably the largest data center in the United States in the shortest period of time for them with Google up at our Lake Mariner facility. Yeah. We like working with them. And as long as the deals make sense for our shareholders, we will hope to continue to do that.
Does Anthropic have any sort of equity stake or any sort of direct stake in the company beyond whatever rent payments they've agreed to?
No.
Okay.
I also want to talk about the other news item from yesterday. In addition to the lease signing with Anthropic, that you also sold your majority stake in the Abernathy joint venture to an investor group led by FluidStack. You're nabbed a profit, or rather that sale going through at $530 million. Why now, and how do you plan to redeploy that cash?
So, I think it was a great transaction for the company. FluidStack always had an option to buy that position. If you recall, we were brought into that opportunity by Google, Anthropic, and FluidStack after that cake was partially baked. They wanted our experience as a developer in managing procurement and EPC companies. They always had the option to take us out. We wanted to make sure we got a superior return. More importantly, it's about opportunity cost. I mean, in that deal, we were half. We weren't leading the development effort. We didn't own the site. That site is not scalable because all the electricity at that site has now been taken up. So we wanted to take that money and recycle it to an opportunity where we are dealing direct with our end user customer, where we get the highest return for our shareholders, where we control the land, control the electricity. So it was a great opportunity for us that came along as we were negotiating the lease with Anthropic for Hawesville.
And let's also talk a little bit about the debt markets, because TeraWulf has really helped to open those markets for other companies. And I'm curious, whether the goal here is to get to investment grade status eventually, and how much more money you plan on raising from capital markets.
Sure. As I indicated in this lease, we have, there are provisions in the lease that mandate we'll have an investment grade credit. We're excited about that. Patrick Fleury, our CFO, I think he's led the leagues here in both transparency and in designing what is financeable in the space. I'm sure we'll do it again. We'll work with Morgan Stanley on that. We're very excited about it. We don't have any indications that we'll do any worse than we've done, and we're certainly hoping to do better. I mean, we're really excited about Anthropic as an end user customer for that duration. 20 years makes a big difference when you look at the financial model.
Paul, really appreciate you taking time for us. We'll catch up soon.
Thank you very much for having me.
Absolutely. Paul Prager, the CEO and chairman over there at TeraWulf. When we come back, we're going to focus in on SpaceX. It's joining the Nasdaq 100 today, and that lockup period for a lot of the sell-side analysts, that also opened up today. We're going to talk about some of the biggest bulls on Wall Street and, well, one of the more pessimistic folks on Wall Street. That's coming up next, right here on The Close, right here on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off with Adobe. Bank of America reinstating coverage with an underperform and a 190 price target, arguing that while the valuation is cheap, the company faces serious competition from generative AI tools that lower barriers to content creation and, of course, erode Adobe's pricing power. The shares, though, nevertheless up about 2.5% on the day. Next up, let's take a look at Cloudflare. Scotiabank upgrading to outperform, saying the company's Workers platform is emerging as the preferred infrastructure for AI-generated or vibe coding applications, including OpenAI Codex sites. The price target at $300, up from $225. The shares up a second day and at one point traded above its all-time high. And finally, let's take a look at SpaceX. Raymond James says the sky's the limit, initiating coverage with a strong buy and an $800 price target. That is a street high. The firm seeing SpaceX's revenue soaring to $5.2 trillion by 2035. Based on its AI business, with the analysts calling the company one of the defining industrial infrastructure companies of the 21st century. Nevertheless, the share is down 6% on the day and at 150.56. If it closed at that level, that would be the lowest close since it first sold shares to the public about 3.5 weeks ago. Now, we do want to go from, well, the most bullish call on the street to, well, one of the opposite ones. Keith Snyder over at CFRA, he initiated the sell rating on the stock a few weeks ago with a price target of just $115, citing the company's extremely ambitious growth strategy. Keith joins us right now to talk a little bit more about that. All right, Keith, it's kind of funny. I look at some of these, let's just say more bullish estimates, and I kind of scratch my head. I guess fine. I can see maybe how you get there. But also, then I look at your call, your sell rating, $115 price target. I also scratch my head there as well. So kind of square the circle as to why you're a little less enthusiastic about this.
Sure. And I mean, so I would say, the nerd in me loves this company. I would have loved to have a buy on it. The analyst in me couldn't get behind the numbers. And really what it comes from is, I did a sum of the parts valuation, just valuing each business individually. I was pretty aggressive with my growth numbers, and I was very generous with my multiples, but I couldn't really get past 1.5 trillion. And so that's where that 115 comes from. That would put it at about 1.5 trillion. And, even in my most bullish scenario where I was giving it almost comical levels of growth, I couldn't get over 2 trillion, which is exactly where it is today. And so, at the end of the day, I have to follow the numbers. I have to be a fundamental analyst, and I couldn't get past a sell opinion on it. And so that's where it comes from.
One thing you said in one of your notes, I think you said this idea that one of your primary concerns is about this idea that the long-term strategy is heavily reliant on Starship. And I am curious as to what is your primary concern? I thought we kind of had proof of life of Starship.
Yeah, I mean, we've had a number of launches. They've been of questionable success. I mean, the most recent launch was only a partial success. There was anomalies in both the first and second stage. And so there's a long way to go on Starship development. I mean, I would love to see it flying. I would love to see it commercially viable. But right now, we just have test flights, and they've caught a few boosters. They've proven that it is flight ready, but they haven't proven that it's commercially ready. And they're placing a big bet on Starship being able to launch a greater number of Starlink satellites at a lower cost. It's kind of the backbone behind their whole AI data center, orbital data center, project. And so they're putting a lot of eggs in the Starship basket. And right now, it's just not quite ready.
And it's interesting, to hear you say that. I mean, the company itself is putting its eggs in the Starship basket, because you take a look at the valuation, it seems like, Wall Street is putting its eggs in the AI revenue basket. And one of your peers on the street, Raymond James, has an incredibly bullish price target on this company, $800. And their expectation is that AI revenue will be more than 90% of SpaceX's revenue by 2035. And I wonder, whether that is a realistic scenario to you.
I mean, it's tough to say. In my evaluation, the AI segment made up about 70 to 80% of the overall valuation of the company, basing it off of just 2027 numbers. But with that said, I mean, right now, if you look at its GICS classification, it's a comm services company. It's an alternative carrier. And so right now, you've got these three businesses all running on their own, and the Starlink product is really the only product that's profitable for the company right now. And don't get me wrong, it's doing great. It's a great product. Its growth is incredible. But, hope is not an investment strategy. And right now we are just hoping that the AI segment can, deliver blockbuster numbers. But there's been no, they haven't shown any growth outside of the three contracts they've signed for data center space.
Keith, literally 30 seconds, the idea of a potential Tesla merger here, is that something that you've modeled?
I have not modeled it. I have discussed it with the Tesla analyst at my company. We do agree it is in the realm of possibility, but we can't understand why we would see that, why they would do it, other than just bigger is better. But I don't know if that's truly the case.
All right, Keith, great to get some time with you. That is Keith Snyder. He is equity research analyst over at CFRA Research. Now, coming up, leaders across the world in Turkey today and tomorrow for a NATO summit. We'll discuss what's happening behind closed doors with Ambassador Kay Bailey Hutchison. She is former NATO ambassador and Texas senator, now senior advisor at the Center for Strategic and International Studies. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romain Bostic.
And I'm Katie Greifeld. NATO leaders, including U.S. President Donald Trump, are gathered in Ankara, Turkey today and tomorrow for a summit focused on defense spending, deterrence, and how NATO can respond to an ever-changing geopolitical landscape. Now, this all happening as questions swirl around the U.S. commitment to aiding European security and heightened tensions in the Middle East. Let's go live now, where we find Bloomberg surveillance co-host Anne-Marie Hordern joining us on the ground in Turkey. Anne-Marie, so you think about the conversation around defense. There is one deliverable here already. We were learning that NATO allies have agreed to at least $50 billion in defense industry deals. Talk us through what we know so far.
Well, Mark Rutte spoke about before this summit how this was really going to be about the reindustrialization of the transatlantic partnership, building on what was agreed upon, which was a major headline at the last summit when NATO members agreed to spend 5% of GDP, 3.5% of that going to ammunition and hardware, true reindustrialization of the defense sector, and then 1.5% going to things like ports, bridges, roads, all the infrastructure needed to support that. And what you see here on the sidelines is all the deals these countries are making to get to that spending target. And they're using European providers as well as American providers. So that's part of the $50 billion that's come out. Potentially, there's one major deal that could be announced. The president earlier today, sitting alongside the Turkish President Erdogan, highlighted his intent to green light Turkey to get back on the F-35 system. Of course, this will have a bunch of legal hurdles because they did buy into the Russian S-400 system, but that could be one major headline taken away here. And then just quickly, guys, to note, this is when it comes to defense money and the spending, something the U.S. has been pushing for, not just the Trump administration. We saw this prior as well with the Biden administration, but also what is going on with Russia's invasion of Ukraine as Zelensky urges for more Patriot defense missiles. And on top of that, what is going on in Iran? This has been the latest source of friction between Washington and their NATO allies.
Absolutely. Well, Anne-Marie, really appreciate your on-the-ground reporting there. That is Bloomberg surveillance co-host Anne-Marie Hordern. And here with her perspective, I'm pleased to say joining us now is Ambassador Kate Bailey Hutchison. She is former NATO ambassador and Texas senator, now a senior advisor at the Center for Strategic and International Studies. Ambassador, great to have you with us. And there's a lot to talk about, but I want to pick up there, this $50 billion in defense industry deals that NATO allies have agreed to. As we were just talking about with Anne-Marie, this is something that President Donald Trump has pushed for, basically NATO to really step up when it comes to spending on defense. How far do you think this $50 billion will go in sort of placating the president?
Well, certainly it's going to be front and center, very important to the president. He's been pushing for this for really from first term to second term. And that will be important that he hear what the allies are doing to purchase and hopefully interoperable assets. We hope that we can share, for instance, airplanes and tanks and some of the things in intel gathering, the missile systems, that we can work together and be able to be stronger allies because we do have interoperability.
And I'm curious also on the other side of things to hear what you make of how NATO Secretary General Mark Rutte has sort of handled the relationship with the U.S. because he has fallen under some criticism that he has been too deferential to the U.S., too deferential to President Donald Trump. And from your perch, I wonder what you make of, how that has developed.
I think the Secretary General is doing a wonderful job. He's got one big goal, and that is to keep the alliance together. And the U.S. must be part of the alliance, and it must be a unified alliance so that when America is doing things in other parts of the world, because we are the leader of the free world, certainly we need to have allies stepping up to do what they can to be helpful in Europe for sure, dealing with Russia, but also in the Middle East, where we have a common adversary, and that is Iran, with a potential for a nuclear warhead and more missile capabilities. So I think Mark Rutte is doing a very good job of keeping the alliance together. Yes, he's been deferential, but there has been tension, and he's working to things back on track.
I am curious, though, behind the scenes, and I understand the importance of sort of creating a more unified front, and certainly the idea that NATO overall as a group certainly needs the U.S.'s military capabilities. But we've seen some of the industrial build-out efforts going on in Europe right now. So if we start to talk about this idea of joint procurement and joint use of military equipment and intelligence, is there a sense that over time we might see a bigger share of that coming from Europe as opposed to the United States?
I think there is certainly going to be a buildup of capabilities in Europe. I think that that will be to all of our benefit, but it must also be an interoperability so that we can do things together that are stronger. So if, for instance, we needed to do something in the Asia Pacific because of China meddling, or in the Middle East, where we know Iran is meddling, we need to be able to do interoperable things together. But I think there's no question going forward that U.S. is the leader of the free world. We do have the capacity to do more things than any one of the other allies. but I do think it's going to be a bigger sharing, as you suggested, from Europe, because they will have more capability.
Ambassador, I do want to ask you also just about the changing nature of threats. The idea of, we go back to the early days of NATO and obviously the concern about being bombed overhead or ground invasions and the sort. There has been a lot of talk, certainly at the last NATO summit, and we're starting to get some more details now about data centers and undersea cables and rail networks and dual-use infrastructure as being, if not a threat, being a vulnerability in certain areas. And I am curious as to how Article 5 would apply to something that maybe on the surface isn't directly maybe a military attack, if you will. I mean, if I bomb you, Article 5, I understand that. If I cut your undersea cable or I go after your data centers or something, does that potentially trigger Article 5, given the importance of that infrastructure?
There is an Article 3 as well as an Article 5, and an Article 3 is a requirement that the NATO allies get together to discuss any kind of attack to determine if there is going to be a consensus for this to be an Article 5. So there is a kind of a breaker that would allow that discussion to be had. But remember that everything done at NATO is unanimous. So once you have discussed something that has happened, you do have to have unanimity on whether it is Article 5.
All right. We really appreciate you taking time for us, Kay. Of course, that is a former NATO ambassador, Kay Bailey Hutchison, now a senior advisor at the Center for Strategic and International Studies. We're going to keep an eye on that NATO summit over the next couple of days here as we get more developments and more news out of that. But we turn back to the public markets as we count you down to the close and talk about one of the biggest individual movers out there, Fiserv, on the move on a report that big Wall Street banks may actually be eyeing one of the company's bank networks. That's coming up next in our Stock of the Hour right here on Bloomberg. Time now for our Stock of the Hour. Taking a look at Fiserv. The share is up for the fourth time in the past 5 sessions. The Wall Street Journal reporting that several major banks are exploring a potential deal for one of Fiserv's debit networks. Here with more on the deal and the probability, if it could even happen, is Bloomberg TV markets correspondent Nora Melinda. All right, Nora, let's talk about exactly kind of what we're talking about here. When we talk about a debit network, basically every time I go somewhere, if I use my debit card, I swipe that, right? A bank somewhere gets a fee on that?
Right, and so...
Oh, so what do they need Fiserv for?
So that's the thing. So they're trying to essentially look at this debit network for strategic reasons, because we do have the Durbin Amendment, which essentially caps the fees that large banks are actually able to charge merchants on debit transactions. So they think that if they're...
Dick Durbin, part of the Dodd-Frank Act back in the day, yeah.
Yes, and so, I mean, we did see in the past where Capital One bought Discover. Yeah. They did talk about the fact that they saw network synergies from that. And so we are seeing all these large banks kind of thinking, can I get a bit more flexibility? How far can I really push it? Am I able to essentially, I don't want to say evade the cap per se, but think about how they can really restructure the business to make sense that it can benefit them in that way.
So what is Wall Street saying about the likelihood that this actually happens, though? Because we do see Fiserv shares higher right now, 2.3% or so, which, again, it's green, but it's not exactly surging here.
Right. And on Wall Street, analysts are essentially saying that it's heavily scrutinized. I would say that this is a really heavily scrutinized idea as to whether or not this deal would actually be able to pass some of those regulatory hurdles. It seems quite unlikely. That's what we're hearing from many analysts on Wall Street. But why you are seeing the stock surging today is the fact that the stock has been down about 70% year to date through yesterday's close. And so we are seeing a pop more or less over the fact that maybe this company does have some valuable assets more than what analysts and investors had been thinking before. So maybe investors had been too harsh in how they were selling off this stock, this company, if we are seeing that some of their assets are valuable here.
Well, what we talk about when we talk about the fundamentals of this company, and the last few earnings reports were a big disappointment. I remember it was like the Q3 or something of last year. They had like that 40% sell-off in the stock after they reported. So, what's the health of this company?
It hasn't been doing well. I mean, also, we did have the CEO just departing the company in June. We have a new CEO coming in. the previous CEO left to go to Truist, but before leaving, he was really hoping to demonstrate some sort of turnaround story for this company. Now we're looking to this new CEO to see whether or not they're actually able to pull this off. But investors are really just looking for returns, and this is just essentially a bright spot of banks and betting on the company and whether or not they actually have some valuable assets to offer.
I forgot they had the new CEO. Yeah, Takis Georgiakopoulos. He just started in June.
Well, there you go. We'll see if this actually does come to fruition. Really appreciate the context.
He went to Columbia, by the way.
Really?
Yeah.
I went to Columbia,
Sure.
the journalism school.
Oh, did you? I thought you went to Haverford.
I did,
Okay.
and then I went on to my graduate career over at Columbia. But I should say thank you.
Which diploma is higher on the wall? That's what I want to know.
I couldn't tell you where either of them are, honestly. That was the breakdown from TV Markets correspondent Norma Linda. We are counting you down to the close. It's just about 15 minutes away. We're going to take you there with Jordan Jackson. He is global market strategist over at JPMorgan Asset Management. This is The Close on Bloomberg.
Just about 10 minutes until we get to those closing bells, Katie Greifeld, and this is once again another tech sell-off. And I feel like this is rinse and repeat. Like, does this mean we're going to rally like 2% tomorrow or something? Seems like every day we have the big, either a big rally, and then that's followed maybe a day or two later by a big sell-off, and we have that today.
Yeah, historical recent history would suggest that that is the pattern here. So you can see we're down about 0.5%, and again, it's tied to the chip makers. That was the big winner on the upside yesterday, the big loser today. You do see a sell-off materializing in the bond market, which is interesting, though. The 10-year Treasury yield back above 4.5%. A lot of that is tied to oil rising. We heard from the U.S. Treasury Department a little bit earlier today, revoking a waiver that allowed the sale of Iranian oil. So that situation still very much continuing here.
Absolutely, and it gets to this idea here of all of the risk piling up, particularly as we now head back into earnings season, where a lot of these companies, of course, have to put their cards on the table. It never ends. Katie Greifeld. Joining us right now here in Studio 2 is Jordan Jackson, global market strategist at JPMorgan Asset Management, counting us down to the close, and more importantly, kind of counting us down to earnings season, which basically kicks off next week. And I am curious about this whole issue of high expectations. We kind of saw that play out with the whole Samsung thing in South Korea overnight. But I was also looking, I kept being told by a lot of folks that we were going to start to see a broadening of this sort of earnings picture. But then I was looking at the Bloomberg estimates. We're talking like 20+% growth for the quarter on the S&P 500 as a whole. Yep. Strip out technology, and that number drops to 11. When do we start to see a broadening out of the earnings picture?
Well, I think we first want to put a little bit into context, right? 11 is not really a bad number, right? From a broader sense, still double digits. And when we look at some of those sectors, those value-oriented sectors, even last quarter, materials, industrials did quite well, with the exception, of course, of energy, which is going to be a big bounce back in terms of the reported earnings that we get in the second quarter. But I think the most important barometer, markets price off expectations. And the bar for these earnings expectations continue to be moved higher. These chip makers delivered stellar earnings. We're in a historic earnings cycle right now. But again, that bar has been set significantly higher. So it becomes more challenging for the markets to kind of keep pace with this earnings projection.
Do you anticipate, I mean, let's just take Samsung, for example, profit growth 19-fold. By any measure, that is phenomenal. But we had the sell-off over there in Korea, and it raises questions about what happens when we start to get Micron, NVIDIA, and all of these high-flying tech names. And does it matter what they say? Like, it's almost like any number they put out there, unless it's just completely eye-popping, they're going to face the potential of a sell-off?
I think that's part of the big risk to the market, right? The markets are almost priced for perfection, from an earnings perspective, from a broader economic perspective, and still very concentrated in a small subset of the market. It kind of feels like sort of the Harry Potter sorting hat. The markets are going to figure, which area of the AI value chain that it's going to focus on next. And right now we're in the memory phase, but we're still finding opportunities within that value stack. We like power. We think software earnings have been resilient and it's probably sold off a little bit too much. We still like the picks and the shovels, so to speak, in the market. So, this is a market that is presenting us, opportunities more broadly, and we still think this is, undergirded by earnings. Keep in mind, the valuation of the market has come down this year, even though we're flirting with all-time highs. Yeah,
it's a good point, and it seems unintuitive when you think about just how far we've come on a performance level. But talk to us a little bit about what you're seeing when it comes to the hyperscalers, because you mentioned that, memory is certainly the apple of investors' eyes right now. But then you have a lot of folks, including Morgan Stanley, coming out and saying that hyperscalers look cheap here. You think about how they've been beaten up, and I wonder how you're viewing that cohort.
Yeah, it's interesting because it feels like the market has moved past the hyperscalers, but they're still expected to deliver, still very strong, very resilient earnings growth. The cohort is no longer acting as one kind of behemoth. They're kind of moving to their own beats of their own drum, so to speak. We like certain companies that have access to kind of all levers of the value chain, so that puts a few of those kind of at the upper kind of overweights within our broader book of business. But I think the markets want to see the money. They want to see the profitability. They want to see if you're going to be raising your CapEx, you need to be raising your revenue targets commensurately. And if you're not doing that, the markets are kind of not too excited about the amount of spending that we're seeing. I mean, we're expected to see $1 trillion in hyperscaler spend next year alone, and a decent portion of that could very well be financed in the debt markets, which it still doesn't, for me, seem to be an issuer problem. But I think it's more so of a bond market problem in terms of absorption of that issuance.
Well, talk to us a little bit about that, how you're thinking through some of those factors, because, I mean, as you mentioned, the debt primary markets have been on absolute fire. We saw Amazon, for example, come out today with their own offering, and I believe that was oversubscribed, but still maybe starting to get a little bit of a cooler reception. You saw that with SpaceX's debt offering as well. When you put together those tea leaves, what are they starting to say?
I think it's starting to say that, we are looking at, and this is coming back to a broader portfolio problem. We talk a lot of concentration risk in the equity market, but we're forecasting increased concentration risk also in the bond market as well, as we're starting to see these hyperscaler issue debt at the same pace as some of the financials, which are big issuers of debt as well. And if we're looking at, say, an IG market right now that's about 10% in tech, we could see that number get 15 to 20% over the next couple of years, just given the issuance that we're seeing coming through. That introduces structurally higher positive correlation between both your equities and your bonds within your portfolio. And so we've got to be a little bit more thoughtful about how we craft a well-diversified portfolio, given that it feels like everything across public markets are going increasingly concentrated in all things AI and tech related.
When we talk about the risk out there, obviously the concentration risk, the technical risk, the fundamental risk is there. Is there still macro risk in any sort of meaningful way out there?
I think the macro risk has waned a little bit, right? The broader consensus is that we are past peak inflation. Even when you look at the most aggressive kind of economist efforts, we've kind of peaked out. Maybe we kind of hover around 4 for a little bit, but come down. I think the job market is showing signs of stability. I think we're stabilizing at kind of a 75 to 100 pace of payroll growth. And we're seeing an economy that is normalizing towards 2%. We don't necessarily buy into the notion that this is an economy that's reaccelerating here. You also have a Fed that we think is the bar to hike rates is still quite high, quite elevated. And so you've got it on net, a Fed on pause, inflation coming down, the consumer continuing to hang in there, particularly driven by upper income households. All this suggests that the macro risks perhaps maybe skewed to some upside risk to growth in the back half of the year, not downside.
All right, Jordan, great to have you back on the program. Jordan Jackson, global market strategist at JPMorgan Asset Management, counting us down to the closing bells with just about 2.5 minutes to go, Katie. And we talk about a market that's been on the back foot all day. We also should talk about a market, an S&P at least, where the majority of the stocks are still in the green. And this has kind of been the yin-yang we see pretty much every day. Yeah, that is the interesting dynamic, that once again, the breadth isn't so bad. I mean, you have nearly 300 names in the green right now, but you look at the downside of the ledger, AMD, Micron, Intel, Tesla, those are some of your biggest decliners on a points basis. But to the upside, you have Meta, you have Lilly, you have Nvidia, you have Microsoft, and you have Amazon. A full breakdown of all of the big market moves on the day with our global simulcast that starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're taking you through to that closing bell. It's a global simulcast. It's already started, folks. Let's go. Carol Masser and Emily Grafeo join us from the radio booth. Tim Senevic has the day off. Welcome to our audiences across all of our Bloomberg platforms. Carol F. Masser here as we look at a sell-off in all of the major equity markets.
Yeah, there you have it. I was thinking to, I said at
what
the top.
What is your middle name, by the way? I just made that up.
Is that like Wheezy
Wait,
F, baby?
what did you say? Carol what?
Does she ever listen to
Carol
me?
F. Master.
Okay. Emily Graffale, how are you, by the way?
I'm doing well.
Thank
I don't
you.
know Carol's middle name.
Nice to see you, too.
It's Anne.
Oh, that's nice.
Cam.
It's like a queen.
Cam. It's Cam.
I like that.
Yeah, there you go. Hey, I think about chip stocks. They giveth and they taketh away, right? So they were up about 2.2% yesterday. Emily given back another 5%. I feel like, again, this story, lots of volatility in this sector. Just look at the HCPI function in the stocks over the last couple of weeks. It's just all over the place.
Yeah, and what's stronger on a day like today? It's again, it's not the chip stocks, it's the hyperscalers, the mega caps, the Amazons, the Metas of the world, actually not doing too badly today, but not enough, of course, to lift the Nasdaq 100 into positive territory.
Romaine, what is your middle name?
I've told you already.
What is it?
Fabulous.
Okay.
We talk about this idea, too, and just to Emily's point, the idea that these sort of sell-offs that we have on one day and the rallies we have the next, it really is sort of indicative of what pretty much every day has been a rotation. It's just a rotation from sort of one pocket of tech to another pocket of tech, and I don't know if this is just musical chairs or this is just how things should normally be, but, well, here we go, and I have a feeling the conversation tomorrow might be the flip side of what you see on your screen today. For our radio audiences, what we see on the screen is red across the screen. A Dow Jones Industrial Average down 140 points, or about 0.25%. The S&P lower by about 34 points, or 0.5%. The Nasdaq Composite and the Nasdaq 100 each down more than 1%, with the Nasdaq 100 closing out the day lower by 1.8%, and the Russell 2000 lower by 27 points, or 0.9%.
All right, back to the S&P 500. Interestingly enough, yeah, the index is down, but you actually had 284 names gaining ground in today's session, Katie, and then you had 218 losing ground, one unchanged.
Yeah, similar story when you take a look at the sector breakdown as measured by the circles. 6 sectors finishing the day in positive territory, 5 in the red. In terms of what did perform today, energy, that is that small bright green slice there, higher by 3%. Healthcare, Eli Lilly having a great day, higher by 1.6%. In terms of what didn't perform, though, industrials down about 1.7%. And then big tech not too far behind. Information technology down about 1.6%. And certainly that was a big weight on the index overall.
All right, guys, let's get to some of the individual gainers, if I may. And there's not a name we necessarily talk about a lot, but it's the number one gainer in the S&P 500. Cognizant stock is up 6.2% in today's session, rallying to its highest intraday since June 22nd, so just about, I don't know, a few weeks ago. This is after the company said it's bolstering its partnership with Google Cloud. So Cognizant is, quote, broadening how the companies bring Gemini Enterprise to clients and deepening its internal use of the technology. The company going on to say it aims to deploy Gemini Enterprise to 100,000 associates this year, with plans to scale to 200,000, and is certifying a minimum of 10,000 Cognizant professionals on the platform. I'm not quite sure what that means. I do want to point out, though, this stock is down nearly 50% year to date, with about 12% of the float short, but getting a little bit of a bump in the Tuesday trade. Let's go on over to Fiserv. That stock climbing after a report that several U.S. banks, stock up about 1.8% here at the close. This is after a report that several U.S. banks have explored a potential deal for a debit network owned by Fiserv. Banks including JPMorgan Chase, B of A, Wells Fargo, PNC Financial have had early stage talks about a potential deal to acquire a debit network owned by this company. So owning that network would help the lenders potentially snag an exemption from the Durbin Amendment, which is part of the 2010 Dodd-Frank Act, going back a little bit, that cap the fees that large banks can collect from merchants on debit card transactions. So it gets a little wonky, but it explains that move. And then, I hope I say this right, I've meant to check it out before I got here. Agios Pharmaceuticals jumping about 17, almost 18%. Today, after the biotech company said the U.S. Food and Drug Administration accepted its supplemental new drug application for Mitapivat in sickle cell disease with a priority review designation. So obviously moving ahead here for a particular pharmaceutical there. Stock is up nearly 60% year to date, with about 11% of the float short. So a few gainers there. What do you got?
All right, let's get to the decliners, and not, too much of a surprise here to see the chip makers down and in the red. Intel is the chip maker that I am selecting to represent the group, falling about 10% to end the day. Of course, this is all coming after Samsung Electronics reported preliminary results that failed to meet high investor expectations. So we're seeing Intel fall, but we're also seeing AMD down. The Philadelphia Semiconductor Index, the SOX index, which has been on a tear, taking some of that back just today. But again, this idea that there's a rotation when the chip names sell off, do investors go and hide out in the hyperscalers? We'll continue to watch that underway. Rivian also sliding, the stock sliding on a plan to offer shares, the stock tumbling the most since 2024 after the EV maker said it will sell 75 million shares to fund equity contributions related to a U.S. Department of Energy loan. Goldman is leading the share sale, according to a filing with the U.S. Securities and Exchange Commission. And at the closing price of $20.14 per share, the offering would raise about $1.5 billion. But again, shareholders maybe not too happy about some dilution that could come to that stock, closing the day down 18%. And then finally, SpaceX down. It's been on a wild ride since it IPO'd. Today was the first day that it was in the Nasdaq 100, and it finished the day down about 7% and dragged that tech-heavy index lower as well.
That's like a chart, a missile coming down to Earth, huh?
All right,
yeah, Carol said it, not me. Sorry.
Yeah, all right, well, let's take a look at what we're seeing in the yield space, which we saw pretty much a parallel shift higher in Treasury yields, about 7 basis points on your 2-year yield and about 7 basis points on the opposite end of that curve at the 30-year. A big sell-off in the Treasury space. Some of this was tied, of course, to that rise in oil prices and some concerns here about the still unresolved situation in the Middle East.
All right, guys, we've got a want when it comes to AI. This is courtesy of a Nobel Prize-winning economist. His name is Christopher Pissarides, I believe, is what his name is. He's warned that AI essentially will not return Western economies to the era of rapid productivity growth, which may be gone forever. He said as many as 4 in 10 U.S. and UK jobs would be largely unaffected by AI, and cited areas such as nursing and hospitality. So all that excitement, he says, not so much.
He said he doubts there will be a new computer boom equivalent to what we had in the 1980s and 1990s, which is kind of disappointing because people are definitely thinking that the AI boom is going to be even bigger than the internet boom.
I'm curious about that because, I mean, a lot of people are putting bank on this idea of improved productivity as being one of the big benefits of this. And we should point out, his whole background is labor economics, and I think his Nobel Prize kind of dealt with that. So he would certainly know. But that's kind of a contrarian call. I mean, a lot of economists, the most respected economists out there, seem to think we are already in the midst of productivity improvements.
We shall see.
Yeah.
You know what's getting cheaper?
Diamonds, perhaps.
Yeah. Romaine's going to buy them for us all.
A sign of the times, potentially, coming from De Beers. I thought this story was really interesting. De Beers making deep cuts to its official diamond prices. Typically, the firm's prices had been between 5% and 50% higher than the secondary market, depending on the category. But now they're cutting them to be much closer to the secondary market. And we know that the diamond industry has been in a weird way for a while here when you think about the shift towards lab-grown stones. So, you know, another step in that story here.
So how were diamond prices, how are they set now? I assume diamonds are rare. Is that the issue?
Actually, not so rare.
Oh, okay.
We're finding out.
So why are they so expensive?
Well,
they're a girl's best friend.
No, like control of supply and demand, right? I mean, essentially, that was such a controlled market, right, for so long.
And now you have supply increasing when you think about what's being done and grown in the lab. And, you know, it's not so great for the natural diamond businesses involved.
I think it's fascinating, right? I mean, this industry has just changed so dramatically over the last quarter of a century. Romaine, what is your middle name?
Diamond Jim.
I could see that. I like that. Yeah. All right, that is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Romaine, Diamond Bostic, and Katie E. Greifeld.
There we go.
There you go. Continuing there on the close on TV, and Emily and I back here on Bloomberg Radio. We'll see you again, same time, same place tomorrow, everybody.
All right, coming up, we're going to talk about a little bit more about what's been going on in the chips sector. Obviously, you had a big shock overnight with those preliminary results out of Samsung. We're going to talk to Stacy Rasgon when we come back after the break, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A bit of a flip-flop from what we saw in Monday's session here on this Tuesday. The S&P 500 closing down just about 0.5%, but most of the action, once again, was in the tech space. We should point out a sell-off that actually started overseas in Korea, with the main benchmark Kospi over there falling about 5%. At one point, it was down more than 8% after those preliminary numbers by Samsung, which were phenomenal, but apparently not phenomenal enough. And that led to a big sell-off in chips, which, of course, dragged the Nasdaq 100 down as well. The Nasdaq 100, Katie, closing lower by 1.8%.
Well, let's talk about some of the individual movers on the day here. I wanted to highlight SpaceX, as we were talking about with our radio friends. Its first day in the Nasdaq 100, falling by about 6.8%, closing, I believe, at its lowest level since its IPO. It's still ahead of that IPO price, but certainly a bit of a wipeout today. I wanted to highlight Meta. This was your biggest contributor to the upside on a points basis in the S&P 500, rising about 2.6%, debuting an AI image generation tool within its chatbots within Instagram, sending shares a little bit higher. But of course, then you think about what we saw in the chip space, as Romaine was mentioning. Micron shares lower by about 4.7% on the day. And that's our top story this hour. Wall Street's best performing corner this year takes a big hit. A sell-off in chip makers dragging down the market, with Samsung's record profit not enough to entice investors. Now that disappointment reverberating from Seoul to Silicon Valley, with investors reassessing expectations tied to that AI spending boom, Romaine.
Absolutely. And who knows more about this than Stacy Rasgon. He joins us right now, senior analyst of U.S. Semiconductors over at Bernstein Research. And Stacy, I do want to kind of talk about this idea of what this current cycle is, because if you believe we are in this sort of long-term super cycle, you probably shouldn't see this panic. But if you do think this is just a normal chip cycle, then maybe a 19-fold increase in profit growth is kind of a thing that you look at and you say, okay, maybe that's the top. How are you viewing things right now?
Yeah, this is an unusual cycle. I haven't seen one quite like this before. And you know, there's a few different types of cycles, right? You've got short-term inventory cycles. Semis are the back of the supply chain. You can get kind of whipsaws, and those last a few quarters. You can get supply cycles. Tight supply, drives pricing up, and we're seeing some of that now. You can get product cycles. You win or lose a socket in a high runner like an iPhone or something like that. And what we're seeing right now, though, is a supply cycle coupled with a massive demand cycle. The reason supply is tight right now is because demand is off the charts. And, it's really funny. Like, AI has gotten so big, it sort of dragged everything along with it. And one at a time, different parts of the space have sort of hit their limits for what they can supply. And by the way, those are the stocks that have really been working. Like, investors really like to play the so-called bottlenecks. We went from the GPUs and accelerators to memory, to semi-cap, to optical, to networking, to power semis, to CPUs. Now it's discretes. All of these different areas, like one at a time, we've had these sort of rolling waves of bottlenecks. And so that, I think, is something that is maybe a little unusual in the sense that I haven't seen a single end market drive demand so high so fast and actually touch almost every area in the space. You could have owned anything almost in semis year to date, you would have been fine. And by the way, I will say, today was there's a lot of volatility and the space was down, and I get all that, but you have to put it in a little bit of perspective. Like, the SOX was down 5% today. It's up almost 75% year to date.
Yes. Yeah.
It's up 120% year over year. And if you think about the year to date performance, people worry about bubbles and all this, but by far the vast majority of the performance year to date is actually because of earnings.
Yes.
It's not really a ton of multiple expansion like broadly for the space. Most of it is the stocks going up because the earnings are going up, and the earnings so far have kind of been keeping pace with the stock move. So I don't worry too much yet. Again, we've got a healthy dose of volatility here, but you could argue that so far the moves we've seen broadly year to date have been more fundamentally driven than anything else, at least for now.
Absolutely. But I am curious just about this idea. Obviously, a lot of people are trying to figure out whether we have sort of reached some top. And you talk about the year-to-date performance, 73, 74% right now. We're on pace right now for what is going to be at least the second best performance on an annual basis for this index. Maybe the best.
We'll see. We got 6 months to go.
We got 6 months to go. But I am curious, one thing that people have raised, that I've spoken to, is this idea of when we start to see an increase in manufacturing capacity. And obviously the Korean government is really pushing this idea over there, an investment of basically 1.3 trillion won. I don't know what that is in US dollars. But the idea is that if we do start to see a meaningful increase in capacity, and I know that's a long runway to get there, does that then upend some of the fundamentals, the corporate fundamentals that have supported this rally?
Yeah, so this is the thing that we do need more capacity, assuming that all the demand we're seeing is real, particularly in the memory space, but in other areas as well. And they are starting to add, but it takes time. Like one of the issues right now is if you're going to, for example, I cover the semiconductor capital equipment space. They make the tools that make semiconductors, and they're all having monster years. And the stocks are down a lot of the last week or two, but they're still up a ton year to date. And the equipment market is growing a lot, but as strong as it's a constrained year. Before you can ship a tool, you need to have somewhere to put it. And we're short clean room space. And so before the industry can really start to add a tremendous amount of capacity, they actually have to build the clean rooms, the factories first. And that takes time. They're starting now, but you probably won't see a ton of manufacturing floor space come online until well into 27, even into 28. And once we have that clean room space available, then you can actually start to ship the tools and start to add capacity in a bigger way. And then we'll see, as the supply comes on. As the reason semiconductors are getting nervous, the investors are getting nervous, is they know how this works. There tends to be a phenomenon that happens when supply is tight and customers can't get what they want when they want, is they tend to order more. It's called double ordering, right? And so in many cases, you'll have very tight supply and a lot of demand. You'll add supply, and when the supply comes online, the customers will say, "Oh, great! Actually, I didn't need everything that I was ordering. Now it's available. Thank you very much." That will become the question as the supply comes online over the next few years.
Right?
Is the demand real or is it phantom? And for example, we had a similar type of surge during COVID. There was a ton of demand, and we had shortages and everything, and the supply came online. And it turned out it wasn't real demand. It took 4 years to work it off, right?
Right.
Counterpoint, though, you go back a year or two when the GPUs and accelerators themselves were in very tight supply, and supply came online, and the demand actually rose to meet it. That demand was quite real.
Well, Stacy,
so we'll see.
I want to talk a little bit about whether, the perception of these semiconductors, specifically the memory industry, should change here. You mentioned all the different ebbs and flows and different periods of time. This is still an industry that's seen as very cyclical. We had a note out from Morgan Stanley's Lisa Shallett talking about how there is going to be a mean reversion that comes to these earnings. But when you think about some of the shortages that you mentioned, is it still fair to say that this is a cyclical industry and things are going to revert?
I don't know. It's presumably what comes up comes down at some point. Although I do think that there are some things that are different. So this time is different is always a dangerous statement, especially in this space. However, you can look at the DRAM space, for example, which is one of the areas that's in the tightest shortage rate right now. DRAM is like the system memory, for example, in your computer or your smartphone that runs your operating system. AI uses a special type of DRAM. It's called HBM, or high bandwidth memory. And semiconductors they're made on wafers, right? That's sort of the measure of capacity. To make a gigabyte of high bandwidth memory for artificial intelligence applications takes something like 4 times as many wafers to make that gigabyte versus making a gigabyte of standard DRAM that would go into your PC or your smartphone. So you have a scenario where you could be adding a lot of wafer capacity, but not necessarily adding a ton of incremental bits relative to what you would be doing ordinarily. And so that is something that is different, right? I'd also just say, again, the demand environment from AI is just insatiable, and this is something that is maybe a little different. We haven't had a single end market driving this much demand across everything in a long time.
Right.
So I think there are some reasons to believe that this can continue for quite some time. Would I be willing to stand here and say it'll never come down? I don't think anybody knows. But I think that'll really depend on the demand environment. Again, if everything gets built out to the extent that I think everybody's currently forecasting, this will probably last for a long, long time. And I would say if it doesn't get built out like that, we're probably screwed anyway. So it probably doesn't matter one way or the other if memory rolls over or not. I think everything would be challenged, probably both in and out of semiconductors. Right? I think data center spending right now may be the only thing that's holding up the economy broadly.
Yeah, well, it certainly is a big force. We've seen that in the official numbers. But when it comes to demand, again, I want to talk somewhat narrowly about the memory industry specifically, because you think about the pricing power that these memory chip makers have right now. And you saw that interesting move by Apple a couple of weeks ago, having to raise prices on some of their products. They blamed the cost of chips to do that. And I wonder at what point that demand that we're seeing, maybe when demand destruction becomes a risk here. I think we might have lost Stacy, because I don't think that.
Stunned him with that last
Apologies, I had a power
outage.
Put me back in.
Oh, we got you.
We just had a power outage at my house. Maybe there's too many data centers sucking up the power. I don't know.
All right, go ahead, Stacy.
Sorry about that.
Yeah.
You were about to ask about the demand, I think.
Yeah, so I think we're going to work on reestablishing that connection with Stacy. Again, I mean, it is an interesting question, and it's one that we were asking when we did see that initial news from Apple. You think about, again, the pricing power. These memory chip makers sort of have the luxury of setting prices right now, but you think about the end consumer who's buying the products that these chips go into.
Yeah.
At a certain point, it's too much.
It's too much. And there's also this other idea, too. I mean, we go back to the capacity issue. Obviously, with the memory chip makers, it's about building these new fabs and things like that. But also, I mean, every hyperscaler seems to be working on their own chip of some kind.
Yeah.
Every other company, basically, if you have the cash and you have maybe the willpower, you're at least trying to figure out something long term. And obviously, these are types of projects that aren't going to happen overnight. These are runways of multi-years, but it gets to the idea that the chip landscape might look a lot different, maybe 5 to 10 years from now, than what it looks today.
Yeah, and I mean, that conversation extends beyond just chips. There was a really interesting news item from today. Microsoft coming out reportedly looking to reduce its AI costs, and as such replacing OpenAI, Anthropic with its own AI in some apps here. So again, it's a broader conversation when it comes to AI and how some of these enterprise customers are approaching it.
All right, great conversation there with Stacy Rasgon over at Bernstein Research. Obviously, a bit of technical issues there. We'll try to get back to him in a minute. I do want to bring some breaking news to the attention of our viewers. Shares of Coty were at one point up as much as 8%, and then we're down as much as 6 or 7%. This after we're learning that the company has resolved the issue with regards to the license for Gucci fragrances. Remember, this is a brand license that they had that it made up anywhere from 8 to 11% of their revenue. However, Gucci Kering had entered into a pact with L'Oreal that essentially would transfer over that license in 2028. There had been litigation over it. Coty has resolved that litigation, saying they will exit the partnership early. A lot of people trying to figure out what this means, but remember, this had accounted for about 8% of its sales and more than 10% of its profits, so something that it'll have to address on the next conference call. When we come back, we're going to talk to the CEO of American Century. Stick with us. This is Bloomberg. A new quarter, a new market playbook. American Century Investments out with its latest update on what they expect for the rest of the year, noting that market leadership is shifting and, quote, the case for diversification is particularly compelling now. Joining us right now is the CEO at American Century, Jonathan Thomas. He joins us now on the back of that report. John, great to have you here on the program. Talk a little bit about kind of what you are seeing with clients, particularly coming out what overall, at least for equities, was a phenomenal first half. Are you seeing any sort of shift in behavior heading into this second half?
Yeah, Romaine, we are, as a matter of fact. Thanks for asking. We're seeing, I'd say, 4 major themes that are going on here. One of them, of course, is the economy remains really resilient despite all the multiple shocks that it's experienced. We're seeing a rotation back to the U.S. recently compared to non-U.S. stocks. We are also seeing a move towards a higher quality debt as opposed to the lower quality high yield opportunities. And after a 20% run up in the first half of the year for the Russell 2000 and small caps, we're seeing a little bit of a rotation back to large caps in the U.S. as well.
I am curious. I mean, you've been at this job a lot, and you've seen, obviously a lot of cycles, even before you became CEO at American Century. When you look at sort of the valuation run-up that we had over the past few months, which most people would justify based on the earnings run-up that we also saw here. Is there any sort of precedent, in your view, of what we're seeing right now? Any parallels out there, or is this just kind of one of these unique times in our American, business history where we just kind of have to live with what is a big transformation and the volatility that comes with it?
Yeah, it's easy to get caught up in all the short-term stuff, but I was just looking at this stat the other day. I was going back 5 years. So far this year, we've had 24 record highs on the S&P. Last year, for the full year, we had 57 record highs, which we're actually running lower than that if you annualize this year's numbers. The year before that was 57. 22 and 23 were 0. And 21, which you guys know is a record year, we had 70 record highs. So I think what you're really seeing, if you kind of look back, it's always difficult to put money into the market at times like this. But generally speaking, these record highs are more of an indicator of a bull market than it is than some sort of imminent pullback. And that's what we continue to expect to see with, the economy being resilient, inflation generally in line with expectations. And, the other thing that's happening there is Kevin Warsh is kind of redefining how he measures inflation, kind of looking now more at what he calls underlying inflation as opposed to the inflation that's been favored by his predecessors with PCE that actually included the shocks. So. Yeah. Between the economy, the inflation, and then consumer, both income and spending, especially at the high end, remains really strong.
Right. Well, Jonathan, I want to go back to what you were saying about the rotation that you're seeing outside of the U.S., because I'm taking a look at the American Century ETF lineup that you have right now. I like to look at year-to-date flows, and it's pretty interesting. I mean, your emerging markets ETF is your biggest flow getter this year, $5.8 billion taken in so far, actually edging out your large cap ETF, which isn't something I have to imagine that we see all too often. So what are you seeing? What are you hearing? What's the case for investors really going into EM right now?
Yeah, so, that's kind of a first half story. Like I said a moment ago, it's slowing a little, and you see a little bit of a more of a rotation now into the large cap domestic compared to the non-U.S. But obviously, the emerging markets have been hugely powerful for the last year or so with extraordinary returns. And, a lot of those ETFs are purchased by consumers, retail consumers, sold through our advisor network. And the excitement around the returns there has been extraordinary. And of course, as you probably know, for many years, most portfolios have been underexposed to the emerging markets. And a lot of that is just catch up that's been going on in the first half of this year.
And something else I'd love to get your thoughts on is basically the definition of value, because I'm taking a look at some of the notes that you sent over to our producers. You make the point that you think about some of the AI-related mega cap stocks. They're now in Russell value indexes. And another stat I would bring to you is you think about Schwab's value ETF, their large cap value ETF. It actually holds SpaceX, which feels really unintuitive at this moment. So what does value actually mean these days?
Well, it's shifting for sure. Just like the categories of mid, small, and large cap move, value has been redefined, honestly, over the last several years. I think you see a lot of names like SpaceX that everybody expects to be a major growth story, even though most of the people have purchased it since the IPO, I think, are down a little bit. But at the moment, it's seen, and it is a diversified portfolio. Obviously, it's not just a single stock story. But I think there is increasingly more and more stocks going into the value category based on the historical run-up we've had. But, that concentration that we've seen where so many, just a small group of stocks were considered growth stocks. We all know about the Meg 7. I was just looking at some stats for this year. right at 50% of the stocks in the S&P this year are up over 10%, which is extraordinary compared to the concentration we've had recently.
Yeah.
And actually 22% of them are just in the 10 to 20% alone. So what you are seeing is that broadening out of the performance, which is bringing more and more stocks into people's portfolios, and at the same time getting more value qualifications.
Hey, John, we only have about a minute left. Before I let you go, I just do have to ask more about specific your business, the health of it, and more importantly, the charitable efforts that your founder, the founder of American Century, set up for medical research. Of course, a foundation that's also being reshaped by AI. Can you just talk a little bit about some of the progress that is being made and whether you're actually seeing an acceleration potentially in some of that progress because of some of the new technology that's out there?
Oh my gosh, it is unbelievable what's happening. Yes, so American Century, we, as a result of an original gift from our founder, Jim Stowers, we to this day currently direct over 40% of our dividends each and every year to medical research to find cures for cancer and other gene-based diseases, support a group of about 550 scientists. The impact that AI and technology is having in the pharma biospace is phenomenal. And I think that achievements that we thought at one point might have been 7-10 years out are probably 3 to 5 years out right now, based on the acceleration. We're seeing it, we hear about it in so many other areas, but it's actually super profound in the medical research space as well. And it is helping all of our efforts create a better world for mankind.
All right, John, that's a good place to leave it. Really great to get some time with you. That is Jonathan Thomas. He is the CEO of American Century Investments. Meanwhile, let's take a quick look at how markets closed out on the day. The S&P 500 down about 0.5%. A lot of that pain coming through in big tech. The Nasdaq 100 off by about 1.8%. You saw Korean stocks fall nearly 5% after those Samsung earnings. And then the Philadelphia Semiconductor Index off by about 4.7%. This is The Close on Bloomberg.
Illiquidity is a virtue. Illiquidity means stability when everything else is going up and down. And so what we say, private credit is not a illiquidity solution. It's a volatility solution. It's a diversifier.
And that was Randy Schwimmer. He is the vice chair of Churchill Asset Management, joining us on the show yesterday, weighing in on private credit. Tony Tutrone, he is global head of private markets over at Neuberger, noting back in January that risks in private credit are overblown. And I'm pleased to say that he joins us now. Tony, it's great to see you.
Great to be here.
So that was the view of yours back in February. Bring us up to speed today, the current lay of the land as you see it, because those redemption requests, they're only getting bigger.
They are getting bigger. And so if you look at just default rates, they have inched up. So there is a reason to be watching this closely, but they're still at a historical low. I think the real story is the dispersion of return among managers has grown incredibly. There's just some managers that did get over aggressive in that 21-22 period who stretched on deals, and you're starting to see it in the numbers. So when everything, rolling back a few years, when everything was great, everyone kind of looked the same, but now individual managers are looking very different.
Well, you think about 21, 22, some of the deals that were getting signed, obviously software was a hot item back then. And you think about what initially sparked all of this panic, this consternation, it was software exposure. So give us a sense of what you're seeing, how exposed the industry truly is to software and what some of those vintages look like now.
Yeah, there is a lot of exposure to software in private credit. But when we dig through it, we really believe the vast majority of the companies are mission critical, great companies that have strong cash flows. It may be more of an issue on the equity side because valuations have come down a lot, but in general, feeling good. And I will tell you, the problems we've seen in software credit to date have nothing to do with AI. They were just not great deals in weaker companies where they really stretched on how much leverage they put on those companies.
Well, that's what I'm curious. I mean, how much exposure do you have on the direct lending side to software? And were most of these sort of deals done before kind of, the AI, ChatGPT, came into, the public consciousness?
Yeah, I think a lot. So for years, software was the best place to lend. there was almost no defaults in software for decades, because once you get into a company, the switching costs are so high. And the better private credit managers focused on those types of software, the ones that are mission critical, that are tied into the operations, that have exclusive access to data, et cetera. But I think as the market grew and things got more robust and more aggressive, I do think some lost their discipline, went into weaker companies and companies that are much more vulnerable to the threat of AI. So we will see some damage from AI, even though it really hasn't shown up yet.
So would you be comfortable lending into the software space today, like if a deal came across your desk?
I would be comfortable depending on the company.
Okay.
But I think the bar is higher because what you have in software, you have some obvious winners. That's an easy one. You have some obvious losers. That's an easier one. But there is this big gray area where you don't know, because the companies themselves will have to execute to thrive in this AI environment. And it's very hard to predict which management teams will do that most astutely.
Well, in addition to AI, in addition to software, I also want to talk a little bit about the exit environment, because we are seeing an uptick when it comes to M&A. We see that the IPO market's seemingly wide open here. And, the conversation over the past several years has been that private equity in particular has been really antsy to exit some of their investments. Is that pressure still there, or has it been released a little bit?
The pressure is there. LPs want to see more money coming back. 2025 was the second best exit year ever in terms of dollar and number of transactions. But we had a 3-year drought. And so there's a massive backlog of companies. And investors want money back, so they continue to make commitments to private equity and make sure they have the vintage diversity that they want. And look, the war in the Middle East got in the way of things at the beginning of the year. And with that hopefully behind us, I actually think we're in for a really big second half of the year from an M&A point of view and an IPO point of view. And I think you're seeing the start of that right now.
So with regards to exits then, do you think we'll see a drop in secondaries as being that vehicle? Because, we saw that kind of swell from, single-digit percentages of exits to like 20-something% at one point.
So the bad news is it's going to take years to work through this inventory. The good news is the secondary guys are going to be busy for many, many years. And I think any strategy that provides liquidity, there's a real opportunity here, because there's LPs who need cash. There's GPs who want to get cash back to their investors. So I definitely think it's a buyer's market for secondaries. And I don't see that changing anytime soon, even if we get a really robust M&A IPO market the next 6 months.
And before I let you go, I'd love to compare, what you're seeing when it comes to the U.S. market, some of the cross currents that we're talking about, and what you're seeing over in Europe. Is it a similar story over there, or what's the vibe?
The story has been very different, even when you compare private market results to public market results, because in the U.S., because the S&P has been on such a red-hot run, mostly tied to a small group of AI-related trades, the Europe indexes don't have that. So even though European buyout and U.S. buyout has similar returns, European buyout has outperformed the public markets. All that said, I think, look, Europe has some economic headwinds that the U.S. probably doesn't have. So you're looking at slower growth, a little bit tougher investment environment. But there are definitely opportunities there also.
Tony, great to have you.
Thank you.
Did you watch the Argentina game earlier today?
I sure did.
Okay, all right. Well, I hope you got some work done.
Don't tell my boss.
Well, trust me, everyone in this office basically dropped out for a couple hours as well. Tony, great to have you. Tony Tutrone, Global Head of Private Markets over at Neuberger. When we come back, we're going to talk about AI and how it's reshaping the healthcare space, particularly behavioral health. A conversation up ahead with the CEO and co-founder of Spring Health, April Go. That's coming up after the break, right here on Bloomberg. All right, we've talked a lot about AI's impact on finance and technology. Now it's making its mark on the healthcare sector. Companies racing to deploy new tools to improve care and lower costs. Our next guest is at the forefront of that. April Ko is CEO and co-founder of Spring Health, an AI-native global mental health company. Great to see you, April.
Thank you so much for having me.
I am curious about sort of how AI tools sort of fold into this idea of mental health and therapy, which I would always associate with talking with another human being and getting his or her guidance and advice. Square the circle for me.
So can you guess what the #1 use case for LLMs is right now?
No.
It's therapy. and emotional support. So last year, 5% of all LM usage was therapy and emotional support, and then that's actually more than doubled in 2026 to 11%. So the number one use case for AI is therapy. So what that's telling us is that people want to consume mental health care in a different way. AI is bringing on really a mental health revolution and really changing the way people are experiencing mental health care.
Does it give you a way, this new technology also, to measure progress, maybe that in a way with the one-on-one human traditional interaction couldn't?
I think that is expanding access in a tremendous way. I think that LLMs are capturing explosive demand, and I think that it's up to companies like us to serve that demand safely. So, of course, LLMs are not built for mental health support. They're built for engagement, productivity, entertainment even. And so companies like ours who have vast clinical networks behind them, who have safety standards, who have coverage systems to be able to cover people for their mental health care, companies like us should be able to capture that demand and serve that demand more safely.
I'm glad you brought up safety because that is one of the conversations that's out there. You think about, as you mentioned, the fact that LLMs are being used for therapy. To some people, that seems very dystopian and can create pretty unsafe scenarios. So talk us through, how you approach that, what some of your protocols look like.
So when we started out as an AI native company. We are a global mental health AI company from day one. 10 years ago, we were founded off of a machine learning model. But when generative AI came on the scene, we were first to embrace it, and we were very eager to embrace it because we found it to be a very powerful potential tool in mental health. But when we looked around, we were looking for benchmarks to make sure that we were innovating in a safe and ethical way. But we couldn't find any benchmarks out there. So what we did was we created our own benchmark, and we open sourced it. So we created the validation for ethical and responsible AI and mental health called VeramH. It's the first open source benchmark in AI and mental health. And we created it in collaboration with an external AI council. And we essentially gifted it to the industry. And so now we not only hold ourselves accountable to these high standards, but we have open sourced this benchmark and this standard for everyone to use.
Well, in addition to mental health, I want to talk about another recent program of yours, the launch of your neurodiversity program, which is really all about children with neurodivergent needs and basically trying to provide specialized care for them. So what's the vision there? How has that launch gone?
It's gone extraordinarily well. So for us, our mission is to eliminate every barrier to mental health, and family is a huge part of that. Unfortunately, we're in a youth mental health crisis that is acute and growing. And neurodiversity specifically is growing very much in demand. And so we endeavor to be a comprehensive platform across every single specialty, including neurodiversity. And that launch has been very successful and really embraced by the employers and the health plans that we work with.
I am curious, just April, about the business overall. PitchBook earlier kind of named you and one other company as kind of the two big behavioral health companies to watch in 2026. Are you planning to go public anytime soon?
So we're building for the long term. We are building a company that will thrive in the public markets, and we'll go out when the timing is right.
So you haven't drafted an S1 or done anything like that?
We'll go out when the timing is right.
Would you take any additional new funding rounds in the private space?
So we are profitable, so we are not capital constrained, and we are self-sustaining. But we're very opportunistic in the way that we look at the business. We want to continue to scale. We want to continue to grow our impact. And so we'll go out to be public when the timing is right, and we're open to various forms of capital raises in the future.
All right, April, well, keep us updated. Great to get some time with you today. That is April Koh. She is Spring Health CEO and co-founder.
Absolutely. Let's set you up for what to watch over the next 24 hours. A relatively light slate, of course. We're still waiting, of course, for the start of earnings season, ostensibly basically next week. We do get wholesale inventories in the morning, and I guess we get a little bit of a backwards look with those Fed minutes. Maybe get to really hear what happened behind closed doors with Kevin Warsh.
Yeah, certainly a little bit more interesting than usual when you consider we have a new Fed chairman. We do get some earnings tomorrow.
From who?
Levi, actually.
That's jeans, right?
We'll get an update from them. And don't worry, that NATO summit continues. You know, we got some news today when it comes to NATO allies stepping up, committing to spend more on defense, maybe some more action items tomorrow as well.
Absolutely. And of course, we'll bring you any news out of that right here on Bloomberg. In fact, the team at Balance of Power is up at the top of the hour. They'll certainly have some coverage about what we learned with President Trump's trip there to Turkey. Meanwhile, Katie and I will be back tomorrow with all your market moving news right here on The Close, right here on Bloomberg.